Welcome to another quick deal breakdown. My name is John Castle with Multifamily Roadmap. Today we're going to be digging into a 4-unit property that was sent to me that was just listed on the market. We'll see if the market has kind of turned a little bit and see if they're starting to price some deals here that make some sense. Let's dig into this deal. Alrighty. So first off, here's the listing. It's 2933 Horseshoe Pike in Palmyra, PA. It's listed at $500,000 for 4 units. So right off the bat, I know Palmyra is a good area, and a lot of the prices actually are higher than some of the areas in New York that I normally look. But even at 500,000, it seems high, especially when you look at the pictures for the property. It looks like it's kind of run down. So we'll go through the pictures real quick, and we'll point out some things. So it's these two buildings here, 4 total units, kind of square, awkward looking buildings, but good parking area. You can see in this picture, a lot of shingles kind of dangling, so stuff that they've left unrepaired. And if you go through the pictures, big yard in the back and big parking. The one thing you notice when you get through all the pictures is there's no pictures of the units. This usually means that the units are either outdated or in bad shape. If they were in good shape or had new flooring, or just renovated, they'd have those pictures there for you. So scroll down, it says a 4-unit offers an excellent investment opportunity in a very desirable area, which I agree with. Price to sell, I'm not so sure on that. And it's situated on a 0.45 acre lot. So like I said, a lot of room. The one thing with this property is there's no income or expense information. So the only thing we can really get from this listing is the tax information. You could reach out to the broker or the seller to get more information on it, but we can do a quick analysis here and see if it's even worth doing that. The one thing I did find on another listing, it's not on this listing, but one of the units is a 3-bedroom, and then there's 3 2-bedrooms, as you can see here. So total 4 units, 1 3-bedroom, 3 2-bedrooms, and it's listed at $500,000. So let's dig into some of the numbers. One of the things I did see, I looked up the property records, and it was last purchased in 2019 for $250,000. So it looks like they haven't done a whole lot, and they're just hoping to basically almost double their money by selling now. So if we just run through the property, we'll go to the loan. If you just got an 80% loan to value loan at 6.75% interest rate for 30 years. That's the loan I'm going with. Since it's a 4-unit, you'll be able to get the 30-year fixed mortgage. The only income or expense information that we had was the tax amount was $5,611 per year. I estimated all the other ones just by some general estimates that I normally use here. I assumed that the tenants were covering the heating, and that the water, sewer, trash, which is typical for this area, was covered by the tenants. And then a couple of things that I did estimate was $10,000 in renovations for the outside, and then $15,000 per unit. So $60,000 in renovations to the units to get them up, since I assume that they're in rough shape. If we scroll over here, so for the rents, they don't have any rent information, so just estimated at $850 for the 2-bedrooms and $1,000 for the 3-bedroom. And it doesn't really matter so much when you can go through the numbers, that it's overpriced anyway. So whether they have those numbers or not is not really important. For the vacancy rate, I started with 8, and then during the reno period, I bumped that up to 12%, since you'll often have people move out and issues with that higher vacancy when you're doing the renovations. So I bumped that to 12, and then back down to 8% vacancy once it's stabilized in the 2 years. Like I said, the renovation time, I estimated 2 years. Exit cap rate 7%, and then the financing that you get on exit, I did a lower interest rate, so I did 80% loan to value, 5% interest over 30 years. So to get the rents after renovation, to project out, see where we will be, I came to a conclusion of, for the 2-bedroom, $1,250 as a safe estimate, and the 3-bedroom, $1,600. I did some quick pull on Rentometer.com. You can see the 2 bedrooms up here, one for almost $1,100, and then a couple for $1,200. And then you assume, if you're fully renovating them, that they'll be topper end of the market with that $15,000 per renovation cost. And then for the 3-bedroom, you have some down here in $1,800, $1,900 range. but these are houses. So my guess is they'll be a lot bigger of units than the 3-bedroom at the apartment complex. So I estimate a little bit less at 1,600 just to be safe. And then I also just did quick double check as well. I pulled up apartments.com. There's these apartments in Palmyra, 2 and 3 bedrooms, and they actually had 2 baths. I don't think these apartments would have that. And they're renting in the 1,375 to 1,700 range. And you can see they're decently upgraded. The outside is going to look a lot better than this property. But the inside, you do something like that, maybe a little bit nicer. But so just to kind of back up my quick numbers from Rentometer, just .com to make sure that they're correct and at least semi-accurate. So when you plug all this into the calculator, we go to P&L. So we estimated 3% increase in rent after the stabilization period, 2% increase in expenses each year, and then for year one currently estimated the expense ratio came in at 58.4%, which made me comfortable with the expenses that I estimated, because that's generally with what you'll find for a kind of rougher older property, 55%, 60% for where they're running at the moment. And you can see just with the debt, you're going to be running a negative cash flow of $13,000 from day one, so negative 7% ROI. And even at that numbers, 5 years down the road, you'll see the cash ROI doesn't get up very high. We get up at 3.6% at year 5. So not great numbers there. In the property summary page, you'd be putting $200,000 into the property, $100,000 down payment, about 30 in closing, 60 in renos, 10 in exterior reno, giving you $200,000 into this property. And just your IRR, if sold, is negative at 500,000. You leave a bunch of money in the deal. It just doesn't make sense at all. So where does this deal make sense? Just to kind of see where we're at with the market. If you plug in, let's try 350,000. You start to get a little bit better ROI here, at least towards the year 4 and 5. You're getting up at around 10, so double digits, so that's not bad. So let's see, IRR at 17.2% for year 3, and then just kind of stays in the 16s from there. And you would be able to get out 95% of your cash if you did a cash out refi, which is still pretty good as well. I'd probably like to be in this market at least at 20, with things just being a little extra risky with where we're going, recession, everything like that. So 17 is a little bit lower than I'd like, but this just kind of shows you they're still pricing things at 200 or 2021 levels. I apologize, and the rates are at 7%, whereas they were at 3% then. So the big difference in interest rates should bring the prices down, but they just haven't yet. So people are still pricing them, trying to get that great deal. So it doesn't look like we've seen that market shift a whole lot yet. I expect that to be coming, but that's just kind of where we're at now.